While the stock market is down this year, one ETF has quietly made investors 30% richer in just 4 months. No, it's not AI. It's not crypto. It's not some hot new tech company. It's energy. And the reason why is a story most investors completely missed. In this video, I'm going to break down exactly what's happening, which ETFs are benefiting the most, and whether it's too late to get in. Let's start with what actually happened. On February 28th of this year, military strikes on Iran triggered one of the biggest geopolitical shocks the oil market has ever seen. Here's why that matters so much. Iran sits right next to the Strait of Hormuz, a narrow waterway in the Middle East that about 20% of all the world's oil passes through every single day. When conflict broke out, that strait effectively closed. And when 20% of the global oil supply suddenly can't move, prices don't just go up a little, they explode. Brent crude, which is the global benchmark for oil prices, surged over 55% this year, hitting nearly $120 a barrel at its peak. The International Energy Agency, which tracks global energy markets, called this the largest supply disruption in the history of the global oil market. That's not hype. That's the official statement. And while most people's portfolios were bleeding red, the S&P 500 is actually down about 1% this year. Energy investors were sitting on massive gains. So why does rising oil benefit energy ETFs specifically? Simple. When oil prices go up, energy companies make more money. Their margins get bigger, their profits grow, and their stock prices follow. Think of it like owning a bakery when the price of bread doubles. You're still selling the same number of loaves, but now each one is worth twice as much. Energy ETFs hold baskets of these companies: ExxonMobil, Chevron, ConocoPhillips, the big names that pump, refine, and distribute oil. ExxonMobil and Chevron have both raised their dividends by 4% this year and beat earnings estimates. The oil shock didn't hurt them. It made them richer. And because an ETF holds many companies at once, you're not betting on one stock. You're betting on the entire sector, which reduces your risk dramatically compared to buying individual energy stocks. Now let's get specific. Here are the 3 energy ETFs worth knowing about. Number 1, VDE, the Vanguard Energy ETF. This is the one that's up roughly 30% year to date. It holds about 105 U.S. energy companies and charges an expense ratio of just 0.09% per year. That means for every $1,000 you invest, you're paying 90 cents a year in fees. Almost nothing. It's broad. It's cheap, and it's been the best-performing Vanguard ETF of 2026. If you want simple exposure to the energy sector, VDE is the starting point. Number 2, XLE, Energy Select Sector SPDR. This is actually the largest energy ETF in the world by assets. It's even cheaper than VDE at 0.08% expense ratio and holds all the energy companies in the S&P 500. If VDE is a wide view of the energy sector, XLE is the focused version. Fewer holdings, but they're all large, established companies. Lower risk, slightly less upside. Number 3, AMLP, Alerian MLP ETF. This one is different and worth knowing about if you care about passive income. AMLP doesn't hold oil producers. It holds pipeline companies, the infrastructure that moves oil and gas from point A to point B. These companies make money whether oil prices are high or low, as long as there's volume moving through the pipes. Right now it's paying a 7.6% dividend yield. That means if you invest $10,000, you're collecting $760 per year just in dividends, on top of any price gains. Before you rush to buy, a few things you need to know. Energy is one of the most volatile sectors in the market. It goes up fast, but it also comes down fast. If the Iran conflict cools down, if oil supply recovers, if demand drops, these ETFs can reverse just as quickly as they rose. Energy is best used as a tactical position, not a permanent core holding. Think of it as a trade with a clear reason, the Iran supply shock, and a clear exit point when that reason changes. Also, never invest money you might need in the short term. Volatility in this sector is real. So to summarize, The Iran war closed the Strait of Hormuz. Oil prices surged over 55%, and energy ETFs like VDE are up 30%.